In the late 1920s, the world economy seemed unstoppable until the Great Depression hit and everything collapsed. But what actually caused it, and could it happen again? The Great Depression wasn't caused by one event, but rather a perfect storm of stock market speculation, banking failures, trade wars, overproduction, and monetary policy mistakes. It began with the stock market crash of October 1929. In just a few days, including Black Thursday and Black Tuesday, the Dow Jones plunged nearly 90%, wiping out billions in wealth. This crash shattered public confidence and caused businesses and consumers to drastically cut spending. But the crash alone didn't cause the decade-long crisis. What followed was even worse: the collapse of the banking system. Thousands of small and regional banks failed between 1930 and 1933 as frightened depositors rushed to withdraw funds. The Federal Reserve, instead of injecting liquidity, made things worse by tightening the money supply and raising interest rates. That blunder destroyed access to credit and deepened the recession. Globally, countries were tied to the gold standard, which prevented central banks from expanding the money supply. As a result, deflation spread around the world and unemployment soared. Then came the Smoot-Hawley Tariff Act in the United States, which sharply raised taxes on imported goods. Other countries retaliated and global trade collapsed. At the same time, overproduction became a serious problem. Factories and farms had become more efficient thanks to mass production. But wages hadn't kept up, so people couldn't afford to buy what they were producing. Businesses responded by cutting output and laying off workers, which created a downward spiral. In rural America, the Dust Bowl, a series of devastating droughts and dust storms, wiped out crops and forced thousands of families off their land. With farmers defaulting on loans, more banks failed, particularly in the Midwest. In response to growing public outrage, the government eventually stepped in. Hearings like the Pecora Commission exposed corruption in the financial sector and led to major reforms. These included the Glass-Steagall Act, which separated commercial and investment banking, and the creation of the Securities and Exchange Commission to regulate markets. Altogether, these events turned an economic downturn into a full-blown depression. GDP fell by more than 10% per year. Unemployment reached 25%, and millions of people lost their homes, jobs, and savings. But could something like this happen again? Most economists agree that while another Great Depression is unlikely, the risk of financial crises is never zero. In 2008, the global economy came close to collapse. But government interventions, including bank bailouts, stimulus packages, and emergency monetary policies, helped avoid a full-scale depression. Today, central banks have more tools than they did in the 1930s, and the lessons of the past still guide modern policy. However, there are new risks. Global debt levels are at record highs, financial markets are increasingly complex, and political instability can affect economic cooperation. Trade wars, climate shocks, and central bank missteps could all trigger severe recessions. The key difference is that now, governments have playbooks and the political will to intervene quickly when markets begin to collapse. Still, the lessons from the 1930s remain relevant. Excessive speculation, weak financial regulation, protectionist trade policies, and ignoring systemic risks can all lead to disaster. The Great Depression was a turning point in global economic history, and its story is a reminder that markets are not self-correcting. They need oversight, safeguards, and sometimes bold action. For more thoughtful breakdowns of history, finance, psychology, and how systems shape human life, subscribe to Magister Factotum.